Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending March 3rd, 2023. I'm Preston Brent, and thanks for tuning in. Well, let's just take a look at what's been going on this past week. I guess the week's theme can be how high will interest rates go, and there's a lot of determining factors on that. But it certainly has caused the markets to do a lot of whipsawing thus far over the past 3 or 4 weeks. If we take a look at it, let's just kind of take a look at where we've been this past week. You can see there's a lot of green on the screen. Indexes, the US indexes ended higher, okay? Regained some of the ground, not all of it, following their worst weekly decline this year, the prior week, okay? Really not a lot of notable catalysts that can move the markets up or down this past week. Volume was relatively low, but sentiment seemed to appear to gain support, coupled with one of the Fed governor's comments. Once the S&P ended up holding its 200-day moving average. I'll show you the charts here in a minute, but you can see everybody's solid in the green. Year to date, the Dow moved back into the green again from red the prior week. You can see on the upper right-hand side, the PE ratio is still higher than I would like to see it. I do believe we're going to have some more downside action, but there's going to be a couple of determining factors on that, primarily where inflation wants to go and how the Feds are going to deal with it. You can see the dividend yields at 1.73%, 10-year Treasury. While it moved over 4% during the week, it actually pulled back to 3.96 to close out the week. Earnings yield for the S&P almost 5.5%. And you can see the S&P yield over the 10-year Treasury is about 151 basis points. Real yield is still in the negative. Current VIX actually came down a little bit this week, a little over 11%, to close out the week at 18.14. We did get, from economic data perspective, we got durable goods. They posted their steepest decline since the height of the pandemic back in April of 2020. Also, wholesale inventories fell for the first time since July 2020 as well. Although we did see retail inventories go up just a little bit. And the ISM ticked higher in February for the first time since last May. Although it's still in contraction territory at 47.7, the services PMI came in at about 55.1. And that's where a lot of the sticky inflation is going to be showing up, at least so far. The week's biggest surprise, however, was an 8.1% jump in pending home sales. The real estate market's really interesting. There's a couple of things going on in the real estate market. One, there's just a huge imbalance between demand and supply. And that's what's causing the prices to maintain their levels. All they are coming in, and the 30-year mortgage is up over almost 7%, so it's moved up dramatically. But remember, I told you the Fed governor made some comments. That would be the Atlanta Fed president, Bostic. He tends to be more dovish. And he helped kind of spark a rally towards the end of this week when he came out and said that he supported only a 25 basis point rate hike in the Feds at this upcoming March 22nd, when they announce their rate hike. Okay. And even despite the previous week's hot inflation numbers, the markets all of a sudden went from a 0% forecast probability to a almost slightly 30% forecast of a 50 basis point rate hike. That's what got the market so ugly the prior week, giving us the ugly week so far this year. But this past week, Bostic came out and said he supported 25 basis point rate hike, and he said the Feds could be in a position to pause by mid to late summer. All of these words are just that. They're just words, but they have a tendency to move the markets dramatically because the markets are looking for anything positive or negative to react to. Now that we're pretty much done with Q4 earnings, which came in to the negative, all right? So it took the 10-year Treasury yield, which was almost 4.1%, just slightly under 4.09. And it fell back below 4% as we closed out this week. Although the Fed Fund Futures, folks, is now pricing in a terminal rate, meaning their high-end rate of 5.35% around midsummer. That's about 87 basis points over where we are right now. So that would suggest at least three more rate hikes of 25 basis points. Now, all of this again is going to be determined on where inflation comes in. So there's key inflation data coming out this month of March. So just make sure that you're ready for those inflation hitting economic data points. I think the first one's going to be March 14th, and then we get March 15th. We get the CPI, then PPI, and then we get the Feds, and they react to it on March 22nd, as I said. So the current rate is 4.75% to 5%. So you start hiking or 4.75% to 5% is where the current rate would move to if the Feds raise their rates by 25 basis points. So all of this is going to go into valuations, which also goes into where the price action is going to be, and PE ratios as well. Okay. You can see the best performing sector for the week was materials. The worst is still utilities, bringing up the annual. Utilities is underwater by 6%. Communication services, which was the worst performing sector last year, is still off of that dead cat bounce from 2022. It's up 14% so far this year. Okay. And then, of course, if we go across the pond, and let's take a look at Europe first, you can see everybody's in the green year to date and for this week. Shares in Europe, they were kind of has overcome some of the worries about interest rates and focused on signs of an improving economic outlook, right? Inflation in the Eurozone, I think peak inflation is pretty much hit everywhere. In the Eurozone, it eased to an annualized rate of 8.5% in February. It was 8.6 in January. So I'm making the assumption that peak inflation is already there, but the big issue right now the market's concerned with is just how long it's going to take for inflation to come down to that 2% number. Keep in mind the ECB also is looking for a target of 2% like the Feds here in the US. But in many respects, I think Europe's got a little bit further to go, and they're probably more susceptible to a heavier recession than we are. Although, again, over in Europe, just like here in the US, core inflation, where you take out food and energy, actually moved up. It ticked up from 5.3 to 5.6%, right? And the unemployment rate in January pretty much held steady across Europe at 6.7%. Okay. So, and even Bank of England Governor Andrew Bailey jumped in also and just said they still may have to raise rates above 4%. We're nowhere out of the woods, and so be careful of some of these big fast bull rallies. I think there's some short covering. There was lower volume that we saw this week, so markets can tend to bounce around a pretty good little bit. But everybody's in the green, obviously coming out of 2022, and everybody was solid in the red. They're still, in my mind, I'm not convinced yet that this is a new bull rally versus just a bull trap, right? And then, of course, if we go over the Asian markets, you can see the Nikkei is up 1.73% for the week, over 7% for the year. That's really good for the Nikkei. Okay. And Ueda, who is going to be the new Bank of Japan governor, he's going to succeed Kuroda on early April. He basically reiterated his accommodative monetary policy statements as well. So that helped the Japanese markets. We did see their core consumer price inflation, which comes out in Tokyo, slowed in February to 3.3% year over year. So it's nowhere near Europe or here, but that's Japan. They've been in kind of a funk for the past 2 or 3 decades, market wise. But anyway, even though it slowed to 3.3%, which we would consider a home run, that's still a 41-year high for Japan, right? So inflation all around. BOJ also, the Bank of Japan also has their 2% target as well. So we'll see how that plays itself out. And then, of course, over in the Asian markets with China and Hang Seng, which is a Hong Kong index, Chinese stocks are up 2 weeks in a row. Remember, they just opened from zero COVID in December, and the economy is just now starting to come out of it. They are meeting. They have their National People's Congress meeting this week, and it's like the People's Bank of China. They got to put people in it, and the people of China have nothing to do with it, to be honest. It's a bunch of old farts that get together and talk about the policies there. They're kind of the CCP, the Communist Party. There, it is what it is. But the National People's Congress gets together, and they're looking at a better than expected recovery cycle. They're going to still put money into the economy, like Japan. So really, the only two countries that are putting money into the economy instead of taking it out are the Asian markets, Japan and China. Their PMI came out in China. It actually rose to 52.6 in February. Right, January is just over 50. So that is traditionally an expansionary area, but a lot of that, I mean, they had nowhere to go but up once they opened up the country again. All right. So we're seeing domestic activity picking up a pretty good little bit over in China, which we would expect. And their non-manufacturing PMI rose to 56.3. That's their version of the services index. So that's an expansionary area. And then finally, in their troubled property real estate sector, we did see new home sales in China from the top 100 developers going up almost 15%, following a 19-month slump. So when the government lifted the zero COVID, and they also came out and said they're going to support the real estate sector, um, it tends to create goodwill in that sector with China. So that's how those things are kind of shaping up. I'm going to just shift you over to the markets here real quick, over to the charts rather. Let me just switch this around here. We'll take a look at the E-mini S&P 500 futures, and you can see as it comes up on your screen now. Um, we took out. I mean, the big issue was the 200 EMA, and you could see the 200 EMA here. We just took it out. We moved up above it. Um, the 50 EMA. Now this is right here, and let me just I'm gonna edit this just to make sure we're looking at these are, I think, exponential moving averages. So you can see um, we're moving up, we're moving higher here on these rates or on the price action. And wait a minute, this is Microsoft, so it would help if I got you over to the E-mini S&P 500 futures, right? That would help. This is better. So you can see here the 50 crossed over the 200 back in early February. You can see where the 200 EMA held us up. That's good. That's good, solid support. Markets like that. You can see the big day that we had on Friday. We took out my near-term R1. That was the first level of resistance. So in a way, a little bit of a green shoot to the upside. You can see volume, these green bars here, it's below the blue and the purple. So that would suggest volume it came in relatively lower than normal. And you could see the MACD well below the zero line crossing to the upside with this move here. So we could have a little bit of a run here, but I do believe the market cycle still wants to go down. But you could see this big down move that we had here. In fact, if I put it on a weekly chart just to show you, you can see here on this weekly chart, and I'll extend it out here so it looks a little bit better. You can see we've had 3 weeks in a row of a down move. So you can expect at least 1 week of kind of very rarely do we have more than 3 weeks in a row of a down move. All right. We had it going into the end of December to reach a closing price here of 38.68. Now we're back up here again. So I don't see a lot of upside, at least just yet. Nor do I see a lot of downside right now. I mean, what I'm seeing in the markets with the Feds coming up, with the CPI data coming up in about another 7 or 8 days, not this week, but next week, big data points. And then the other big data point that I didn't discuss is the job numbers coming out this coming Friday. The markets moved big time when we got the January jobs numbers out, and we can expect job numbers this Friday has the propensity to move the markets a pretty good deal. Okay. I don't think we're going to get much higher than 4,200. The highs that we've made so far this year were on February 2nd, 4,208. I don't see us taking that out before we get to the Feds. All right. So that's a little bit about what I'm seeing right now. And then you can see the FANG index. Here's a customized FANG index that I have that's composed of Microsoft, Meta or Facebook, Apple, Google, and Amazon. You can see this was an easy trade, this big gap up, and then we just fill the gap. All right, it gapped up on February 2nd, and then we've been giving it up all month of February. We're holding up here on the 50 EMA. All right, and you could see we're about ready to move. We've moved back up on the 200 again, so we could have a nice little move up, but I think it's going to be short change here. It depends on where we get the job numbers. That's going to be the big data point coming out this next week. Okay, and then of course, if we come down and look at volatility, we take a look at VIX. You can see in the VIX, we've come back down. We're still elevated, but we just cannot seem to get much lower than 18. Once we get down in this area, the markets want to go back higher again. And this goes all the way back to January 2022. We don't spend a lot of time down here. Um, and I think folks going to have to get used to it because for about a decade, we had the VIX in 12s and 13s and 11s and sometimes 10s, even 9s. And now the VIX doesn't seem to want to get below 18. Hang on just 1 second, guys. Let me just adjust this for a second. Sorry, guys. Been eating some muffins this morning. Got stuck in my throat. So you can see how the VIX has come down dramatically over this past week, right? And this was basically the month of February. And it's just come down. It's moved up, and now we're coming back down to kind of where we started the beginning of February. Okay. Volatility does not want to go very high right now. If we look at the front month volatility skew, we're in the green, which means there's not a lot of fear in the market. We're in contango. And if we look at the back month vol skew right here, look how far deep we're in the green here. It's in minus 1.2. Basically, there's not a lot of fear out there coming up over the next 90 days. And then if we go out to the 2/8s and we look at this skew right here, look at that, minus 2.9, almost minus 3. You don't need to know what the number means. All you need to know is the deeper in the red we go, the less fear there is going out in time. That's the way the market's ended. Now, this could change on a dime, and that's why I said early on, it all depends on how the feds react to inflation. So we got to watch these inflationary data points very closely. And look at the bond market on Friday. It went up big time. You can see here where we're, and I got to adjust the data points here for 2023 lows. But you can see we're just barely back in the green, okay? Just barely. And then I can see this moving higher, all right? But it's going to roll back over again, which means interest rates are going to go higher. If we look at the 10-year rate, remember the rates go opposite direction of the bonds, okay? So interest rates came down on Friday. You see where we gapped up right here, over 4%, and then we came back down. We took out that prior pivot high. My prior target for the 10-year rate was right in this area here around 4.05, and we came right up to it. So that's going to serve as huge resistance. It's going to take a lot of energy to get us down. I do believe if it comes back down here, it's going to go back up again. So I don't think we're done yet with the 10-year rates moving higher. And one thing I've seen is every time the rates move over 4%, equity markets get a little bit fickle, right? So just keep that in mind. And then, of course, if we look at the euro is going to do just the opposite. So right now, it's fighting the 50 EMA, all right? I think longer term, the euro is going to be a great buy. If I were to just kind of let the system calculate where it can go, it's right up here around 1.11 to the dollar, okay? So I could see the euro moving up there very easily. If we go into recession, then the euro is going to be a buy. Let it come down. The dollar's going to get stronger. And then once that happens, then we're going to want to be a buyer of the euro, right? I know a lot of our members got on the euro way back over here when I signaled to them to go long euro back in early November. And it's just been a great ride, okay, with the dollar getting weaker. And that's the best way to trade a short dollar is to go long the euro, or you can do the forex. You can just go euro dollars, go long. And then, of course, if we come down here and we look at gold, gold is not like higher interest rates. But the good thing about gold is you can see here, it's staying bid. All right, even though we've had this big move down in the month of February. All right, this is the February that between these two little gray dash marks, vertical dash marks moving up and down the chart. Um, and February, the only thing we saw in February is interest rates going up very fast. Once they slow down and back off a little bit, gold is definitely a buy. Okay. Um, and then, of course, if we look at copper, copper is going to go where the global markets go. And you could see this big move here was when China opened up in December. Once they opened up and China started getting going, um, generally copper follows China. We came down and held the 50 EMA. We broke it just for 1 day or 2 days, and now we got back up again. If we break again for a third break and take out that pivot low there that was made on February 27th into February, we're going down lower. I think I would not be wanting to play long copper. The only thing that's holding copper up now, there's a limited supply of copper. But if we run into a global recession, if Europe starts to get hit hard, China's just now coming out of their zero COVID, so that tends to put an upward wind in the sails of the bulls for copper. But if we do move into a recession at mid-year, then this is going to push copper much lower. Okay. And of course, if we come over and look at energy, we've got great trades we've been doing in oil. You can see this up down move. We basically stayed in this range going all the way back to November of 2022, right? We're still in the red for oil, but I think it's going to kind of drift higher again. But it's a great trade for some of the strategies we're doing in oil, right? Just really, to me, it's low-hanging fruit kind of trade where you can do very well making money in oil. And then, of course, if we look at nat gas, we scored a grand slam in nat gas. We shorted nat gas over here, and it just took off, right? It's going to move right back up to my resistance point right here and roll back over again, I suspect. But the trade, it's already done. We did a short over here, and we did a short over here, and it just worked out very nicely for our members that decided to take the trade. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday evening. We'll go into more detail on some stocks and some opportunities out there. Meanwhile, everybody else, I'll see you next weekend for our weekly roundup. Have a great weekend, everybody. Members, I'll see you Sunday evening in our weekly market watch. Take care, folks. Ciao now.